I am on the Internet Capital Markets podcast again with Aditya, who's a good friend of mine and who's educating me about everything crypto and blockchain. And while we've done a number of episodes where we've been speaking with founders who are building on the blockchain, especially on the Solana network from different parts of the world, we've interviewed folks from South Africa, from London, from New York, so many places in the world, but I still feel that there is so much happening in blockchain and crypto that it takes a while to actually start absorbing everything and really understanding everything from the fundamentals. If you're new to this channel, it's best that you start from this very video. We'll try and pin it right at the top, which should get you up to speed so that you can understand all the other episodes much better. So thank you, Aditya, for doing this. And I absolutely love your patience with explaining these things to me every single time.
Awesome. No, it's great. This is fun. I think this is like, we have a lot of these conversations sort of one-on-one where we talk through this stuff. And so it should be fun to broadcast this out and, just open source it for anyone who's interested as well. Okay. So with that, we have there's three verticals really that anyone that if you're able to understand those, you get a good sense of the you get a good sense of the industry. You can start putting in all of the different pieces of news that are coming out. You can start placing them into one of the three buckets, right? And the three are really, the first one is that there's Bitcoin, which is an asset class, and um, it's taken a life of its own way beyond what anyone would have expected back in 2008. And so it's become its own thing. That's one vertical. Then you have general purpose blockchains, your Ethereum, Solana, Base, Arbitrum, any of these. And then you have stable coins, which is sort of like a special case on top of the general purpose blockchain, right? And so this is how I think of a lot of what's happening in the industry right now. And so I'm just going to share that framework out with you and with everyone who's listening to see if it helps people make sense of this, right? As always, a quick disclaimer on two things. One is that we will reference to a lot of things that have prices attached and that can be traded. So it's not a suggestion to go trade any of this. We both don't talk about trading this or price action or any of this at all. Doing this is at your own risk. See what your local laws are and all that. And B, there's also like a lot of this is inherently political, and so we'll end up making some macro comments as well. But again, we're as observers just trying to understand what's happening, and that's the only place this is coming from, right? Okay, so with that, let's sort of start off with Bitcoin as digital gold, right? What is Bitcoin? And ultimately, the Bitcoin blockchain was the first public blockchain that was built out, which did one thing and one thing alone. And even today, it does just that one thing, okay? Which is it maintains a balance of who holds how much Bitcoin in their wallets, right? So it's an accounting system. It's a distributed accounting system. In some ways, a distributed ledger is the term you've heard the most. The only thing it does is that it keeps a track of who holds how much on that blockchain, right? And the way it's able to do this in a distributed fashion is through what is known as proof of work, or the cost that is required to mine the next block, right? So the simplest way to understand the original intention of the Bitcoin blockchain was it was supposed to be a peer-to-peer cash system, right? If you go and read the white paper, which is publicly available, it says that we need a peer-to-peer cash system which does not have any intermediaries in it. And this happened in 2008. So you could assume it was sort of in response to the banking crisis and the banking bailout that happened in the US at the time. The state of Bitcoin today, though, is not as a peer to peer cash system. And so this phrase, like cryptocurrency, is a bit of a misnomer in that sense, because not every crypto asset is a currency or intends to be a currency. Bitcoin today is thought of as digital gold for the simple reason that that's what the early community chose for it to be, right? And I think in part probably because you couldn't do anything else, right? If you were a early if you came across Bitcoin in 2008, 10, 12, any of these years, you, from a capability point of view, the only thing you could do was buy it, hold it, and sort of transact it, right? And so it maybe, so ideologically, maybe accidentally, maybe some combination of this, through a function of its early buyers and believers, sort of ended up becoming a sink for a lot of the surplus money that was circulating in the financial system, right? And now it is at a point where the US government has announced a strategic Bitcoin reserve. Many other countries have sort of said that they want to hold it on their national balance sheet in their central bank. the same way that they do gold, right? And so to then for this next part, this is a bit more sort of traditional economics in the sense that pre 1970 we had something called the gold standard, right? Like you know this, many of the listeners might know this, is that when sort of countries had to trade with each other, they used the gold standard to sort of settle those trades, right? And somewhere in the early 1970s, the US decided through executive order to move away from the gold standard. What happened post that is that, and this is widely talked about now by US officials as well, is that the US has, from that point, sort of 50 years ago, has led to record high debt, right? Where sort of the US has been able to print dollars, has been able to have lower interest rates for a long time, and has led to, I think, 156% of GDP is their debt, around 36, $38 trillion, which is higher than during World War II, right? And because they had to increase interest rates to manage inflation, the cost of servicing that debt has also gone up really high. And so, like, all of this is to say that any global uncertainty about the future of the dollar, right, whether by international businesses, whether by other governments, is sort of now leads to the conclusion that, okay, maybe we will need to have an intermediate standard again. You can no longer use the dollar as a reserve asset. And then the question becomes, what is that standard? Is it gold? Is it silver? Is it Bitcoin? Is it some mixture of this? So I'll pause here for a second and take some questions. But this is
Yeah.
largely the Bitcoin story so far, right? From the time it was started to where it is today.
Sure. So what I'm hearing is you're saying that very soon, because at one point gold used to be the one unit which all countries would agree to had value, and they would trade in it for exchange of value. And then gradually, when currencies moved away from the gold standard, um, dollars just somehow ended up becoming the central currency that everyone would use to exchange value around the world. Now, mostly when we talk about currencies in economy, there are certain conditions it needs to kind of check off for it to really qualify as currency. The first is, of course, countries and governments agreeing to the fact that it has value, and everyone coming on the same page with respect to, yes, this is commonly accepted as having value. At one point, it used to be gold because gold had inherent value, because it was such a noble metal. And the world over, all countries believe that, yes, gold is rare, it has some inherent value, which is why they kind of came on some common ground. Thereafter, when the dollar dominated, it's because the US, largest market, most powerful, through their influence, they could do this, and all governments kind of agreed to it because no one wanted to mess with them. And it was easy because it was the largest market. Practically every country wanted to access the largest market with the highest average order values or propensity to pay and earn dollars in return. So it just happened. Now that whatever we're seeing in 2025 with respect to political issues, countries not getting along, China would prefer that the yuan ends up becoming the currency of preference. Russia is now preferring to trade with countries in its own rubles, because they want to break out of it. Do you think in such a time when countries are not even agreeing on tariff terms, would they agree to the fact that blockchain would become something that everyone would agree to? Or do you think it's kind of like the currency of trade where all the underdogs come together and they say this is the easiest way for us to agree to break away from the US dollar? And if it takes the entire, narrative or the currency preference of the underdogs, which also means that in any economy, whatever industries are kind of outside of the purview of law or considered unlawful or illegal, would then think, okay, this is the best way because Bitcoin trade is not easily caught by the governments. So it also ends up becoming the currency of preference for all unlawful practices. And I understand I could be coming from a bias of a traditionalist, but do you see this happening, and what can be done to ensure it doesn't happen?
Yeah, I think um, it's really so. There's two parts to this, right? One is that how would different countries sort of respond to this in a world that is sort of fragmented or has like disagreements, and then the other is about illicit or out of the system activity. So on the second one first, uh, every blockchain by default is public, right? So you can track instantly and automatically every transfer that happens. And so if you want to do secret money movement, you're actually better off using banks than blockchains, because banks still afford you privacy in that sense, right? And you had cases of many multinational banks having to pay huge fines for, banking with terrorist organizations or any of these things as well. So the part that blockchain doesn't give you is associating an identity to the address, but you can do that at the point of off ramp or on ramp with exchanges or wherever the money connects to the real world, or to like the legacy financial system. So it's very, I think, yes, there was the example of Silk Road, I think, which was set up many years ago, that was used for, I don't know all the details, was used for illegal substances trade, and they use Bitcoin as a payment method. But beyond that, I would say there's no intrinsic quality that makes it, people can use money for anything, but there's nothing about Bitcoin that makes it easier to do illegal stuff with it. It's in fact harder, because it's sort of like a transparent ledger. To your point of how will sort of countries decide, right? I think one of the realizations is that, like you said, there's no one world government, right? There are many governments, and there's sort of a competing market for, let's say, if there was some hypothetical date that this is the date at which the dollar will blow up, right? Let's say everyone knew it. There would be a race to exit at that point, right? And everyone would want to discreetly be able to get rid of their treasury holdings and get other holdings and set up other trade agreements as well. But there is no such date, right? The date will sort of be played out in the market based on trades that people make. And so, yes, I think for a while it was fair to say that it was underdogs that adopted Bitcoin, like Michael Saylor, for example, MicroStrategy. In the last 5 years, as recently as 2020, he's sort of a private individual, not a government, obviously, but he was one of those cases where if you look at the MicroStrategy stock price line, right, it's been flat since 2000 to 2020, and then when he adopted the Bitcoin strategy, it's gone from like a few cents to $370 a share now, and he has, I think, $600 billion worth of Bitcoin under management, right? So you had, let's say, for example, nations like El Salvador making it legal tender, right, is not, I mean, this is this is what you had in like the 2020s. But now you have the US declare a national Bitcoin reserve and say that they sort of recognize um, that this has been, the same way you said gold has inherent sort of qualities, noble metal. This is essentially a meme, right? Like you would like, it is a meme that has played out over 400 years, but like intrinsically, the market cap of gold is not linked to its industrial or productive value, right? It's linked to something else, which is market forces, or the kind of trading activity that happens, which is driven by many factors, including, they say gold is a hedge. It's a hedge against what? It's a hedge against volatility. In the same way, I think it's just playing out that, you just based on the price action, that you have this sort of like collective decision making that's happening in the market, where Bitcoin is being pushed towards that direction of ending up to be like a reserve asset, simply because, just like to get more gold, you have to make effort in the physical world. To get more Bitcoin, you have to make more effort in the digital world, right? I think the supply constraint of Bitcoin is over mentioned. Like, there's a lot of emphasis that there's only 21 million Bitcoin, etc. I would argue that, you know, having scarce supply doesn't make something valuable. There are other things that make it valuable. In Bitcoin's case, I think it's more the effort you have to expend to make an incremental Bitcoin, which means that even if some, like, it's not possible for someone to just sort of double the supply overnight, right? In that sense, it sort of mimics gold, that there is it's tremendous effort, and with every incremental Bitcoin, the effort goes up as the chain gets longer, right? And so I think the place where it's headed to now is that, uh, unless the US finds a way to just pay down its debt and manage it in the next few years, people will gradually, sort of privately start shifting their balance sheets, where they sort of take, in the same way you take on some exposure to gold, you take on some exposure to this, because you just see it in the market, you see this what's happening, and then you sort of act based on that.
Got it. What I'm also hearing is the fact that in the physical world, when any illicit activities really do happen, it's easier to do it in cash or in gold than to leave a digital trail, which is why the fact that Bitcoin came in and creates a digital trail, it's actually tougher because it solved that problem. However, the next question then comes is, even through banks, or say banks of certain countries, which do offer secrecy. Secrecy is offered in the form where they will give you an account number or a customer ID, which is delinked with your name, and because of which, even when the account number gets leaked, no one really gets to know what is the layer of ownership leading up to the beneficial owner who actually has access as well as control over that asset. Do you think it may soon happen that all the wallets and all the identity functions on the blockchain, be it for Bitcoin or for other cryptocurrencies, the governments may say that it is necessary for all exchanges to do some kind of KYC reporting to the government, where tomorrow, if you have a Bitcoin wallet, the government would absolutely know exactly what all transactions you've done. Do you think we're
Yeah.
definitely going in that direction?
Yeah, I mean, it's already happened. So let's say there was a recent story of one of the early Bitcoin whales or holders, whales as they're called, but who sold, I think it was $9 or $10 billion of Bitcoin from a single wallet, right? Now, how are they going to sell it, right? So they had to, you can obviously, you can do a peer-to-peer transaction if you find somebody who can give you $10 billion in cash, but the more likely route today is that you send it to an exchange or to a OTC desk, which will require you to KYC. To They will ask you your source of funds, they will ask you for the the block explorer reference of when you bought it, and they'll go and see if if this has been tagged to any illicit activity or not. So there's this whole infrastructure developing around forensics, on anti-money laundering. This is like a 98% industry of good actors, or largely mostly good actors, who therefore want to work with authorities to create all of these tools so that they can do their business and their job without being brought down by whoever. Obviously there are scamsters in this industry like there are in any industry, but there are tools. So if there's ever a hack that happens, recently one of the Indian exchanges lost around $50 million from one of their wallets. You There are and that money immediately gets withdrawn to some blockchain, right? There are a bunch of teams that are now professional forensic auditors which will tag that money, right? And so it's almost like how, in cash, you put in that color into the ransom bag. Like I've seen this in movies, like they put in, where you mark the notes, right? And so you can track them. You can now it's very easy to digitally tag that money, and so you can bounce it around as much as you want anonymously. But the minute you go to convert it to cash, which is not going away, by the way, like I don't think at any point there's a presumption that Bitcoin will replace government issued fiat currency, right? Because that is the power of the sovereign, the power of the government, the land you live in. They will always, like, as long as the government is functioning, they will keep a sole monopoly on the right to issue currency, and that's their mandate. So you will have to convert it to cash at some point. When you do that, this money is tagged, and it's pretty easy to find out. Where it's come from and trace it back instantly.
Wonderful. In fact, I might even ask you to help us all understand that if someone really wants to get on the ecosystem to learn, it's almost like equivalent to opening a net banking account for themselves, especially when it comes to cryptocurrency, just to be able to learn and get into the system. I think we might even do an episode where I'll ask you to do a walkthrough for
Yeah.
all of us so that everyone can get started. But before that, I know you spoke about the three
Yeah.
pillars. So my next immediate question comes to that, okay, Bitcoin was the starting point. I remember speaking with a friend who said that I don't trade in cryptocurrencies, but I have this hunch that one Bitcoin, 10 Ethereum, and 100 Solana um, by 2030, 2032 should be equal to $1 million each. Okay. And this is a very smart friend, if I may, super smart guy. I really do trust him, but I didn't really understand where that hunch came from, or the fact that we all understand now what is Bitcoin. But what is
Yeah.
the deal with Ethereum and Solana? How are they different? What is the use case?
Yeah.
Where do you think his hunch is coming from? Can you reverse engineer this logic for me?
Yeah, I mean, look, there's this saying that a lot of like technical analysis or price forecasting is like astrology for finance bros, and so I, I I can't reverse engineer the ratio, but I will talk about Ethereum, Solana, and some of these general purpose smart contract platforms. more broadly first, and then at the end of this section, we'll see if we're able to sort of together make sense of make sense of how to think about them, right? So like I said at the start, right? The Bitcoin blockchain did one thing alone, right? It just maintained balances of an asset. And so somebody saw this and said, hey, this is actually really useful, but why can't it do more things, right? Why is it restricted to debit and credit only? Why can't I enforce sort of custom logic? Like, let's say you and I have a bet about something, right? And in any two-party transaction, you have an escrow, right? And escrow is like a trusted third party where you deposit money, and then if you're buying a house, and there is instead of a human escrow, why can't you have a digital escrow, right? Now, if you build a digital escrow on top of the banking system, anybody at the bank can sort of pull the plug on that and say that, hey, you know what? Sorry, we need to actually hold up the payment. But if you could build an escrow on the Bitcoin blockchain, nobody could hold it up, right? And whatever the conditions are embedded in that escrow, the minute, let's say you have it on, let's say it's like insurance for a farmer, right? That if the wind speeds go above 300 kilometers per hour, then you get paid out your insurance, because that is going to be there's going to be a hurricane, and it's going to damage your farm. um, you should ideally be able to build that into a platform like Bitcoin and say that, hey, you know what, we'll have a source of data, and the minute this data says that the wind speed has crossed, the payout will happen, right? And there are cases.
Okay. So it's conditional payments
It's
in a way.
basically just,
It's
yes, it's
conditional
basically
payments.
any kind of custom logic that involves the movement of money, right? And there are cases where you don't want that, right? There are cases where you do want a human arbiter, and that's fine as well. This is just creating a new capability that can be implemented as and when required. So there's this person who had this question, and they used to run a Bitcoin blog, and they used to meet Bitcoiners and talk about this. Now, to be able to make this change to the Bitcoin blockchain, you need anybody who is running a miner, or at least a sufficient number of people who are running miners, to agree to the change and implement the new version of the blockchain onto their miner, right? Because we said it's a distributed system, right? Which means that there are hundreds or thousands of people all over the world who are running these, unrelated nodes that are all creating this one network. And so I think they were basically unable to. There's this resistance in the Bitcoin community, or this sort of ideological purity, to say that we will not touch or modify any of this. This will always just do this, right? And that has served them well, clearly, because it is like the largest asset in the industry. It's industry defining asset, whatever. And so, therefore, this person, whose name was Vitalik Buterin, said that, you know what, I'm going to build a general purpose smart contract platform that takes this property of Bitcoin, of being distributed, of allowing, of not requiring a third party for transactions, but I'm going to make it a general purpose platform where you can write any custom code. So you can write, and there's a language called Solidity in which you can write this code. So it could be, if wind speeds go above a certain thing, pay out an insurance. It could be to sort of resolve a bet. It could be any sort of financial transactions, or any transactions, really, like e-commerce. If there's a return, if the product doesn't meet a certain spec that is fed into it, just refund the money, right? And so there's a whole new class of blockchains that are these general purpose smart contract platforms. Ethereum was really the pioneer of this. They were the first ones to build it out. You then have, now more recently, you have Solana, you have Aptos, Sway. There are a lot of these blockchains which are called layer one blockchains. And so it's independent of the Bitcoin blockchain. It's its own blockchain with its own validators, with its own native token called ETH, which your friend was referring to when he said 1 Bitcoin, 10 ETH. Um, that's what the system does. And it lets you write any logic, right? Borrow, lend, payout, dividend distribution, any sort of financial logic can be created on that. And that's the general framework to think about these smart contract platforms.
So that's a great explainer on exactly what Ethereum does. Can you also tell me now what is the purpose of Solana and how is it differentiated from Ethereum, and which are the other such cryptocurrencies that a general person just getting into this should know of? Maybe the top five, and what is the edge or what is the differentiator?
I think so. What happened when Ethereum came out is that people realized that, okay, you can now write code on this blockchain, right? And so people started creating applications. One of the first breakout applications was Uniswap, which is a DEX or a decentralized exchange that allowed people to trade with trade any of these cryptocurrencies with each other on the blockchain itself. You had what is called DeFi summer, right, where DeFi is decentralized finance, and people were then able to, you could mint whatever tokens you wanted. You could trade them against ETH, or you could just do all this financial activity on the blockchain, right? And of course, a lot of it turned out to be purely speculative. You had the ICO phase, which is predominantly known for tokens that raise a lot of money. The team made money, and then the tokens went to zero. As with anything new, right? You have to be careful with this stuff. But but sort of the fundamental technology was very useful, because you could create these pools. Like you had a competitor to an order book, which was automated market maker, right? Which was just software that could do these trades that you require an exchange order book running. You could just now mimic that with software and compete with it. But what happened was that the way Ethereum was built is it was basically slow and expensive as demand grew, right? It was great when there were fewer people on it, but as more and more people came on, it started becoming really expensive and slow, in the sense that you need to pay gas fees to get a transaction made, right? The whole point, like when you use Instagram, effectively Mark Zuckerberg and his team are paying the cost of the infrastructure. And of course, they're able to generate revenue from it, and that's how they run the company. Ethereum being a decentralized network, someone has to pay the people who run these nodes and run these validators and keep the network going. That's basically what a gas fee is. It's a network fee that is paid to the people who run these nodes. Now,
It's almost like a commission on marketplace. So people get on an Amazon in the early days and it's easier to sell and the commissions aren't high. But as you go along and the platform is so big and they also feel they have the power to charge, do you think it's also driven from the fact that now the platform feels now I'm big enough, I've got these many users, I might as well
no, no,
milk
no,
it
no, no.
and thus increase the gas? Or it's all
It's
utilitarian and it's very linked to costs?
it's basically programmed in. The units of gas are sort of programmed in. It varies depending on the technical complexity of the transaction, but it's absolutely nothing like a marketplace commission where you can use it as a revenue lever. It's more of like a technical fee that you pay, just based on like the cost of running the network, the number of transactions wanting to come in. It's more of like a technical fee. And so what ended up happening is that the fee there was a time when it cost like a few $100 to make a transaction on Ethereum, right? And part of the reason why that happened is because the the gas fee is denominated in the native token of the blockchain, right? So on the Ethereum blockchain, you pay your gas fees in the ETH token, but people also speculate on the ETH token, right? Like people who want to make a directional bet on any of these things. And so when the price of the ETH token goes up, the cost of using the Ethereum blockchain also goes up, right? And so in the peak crypto bull, when you had ETH trading at 1,000, 2,000, now it's crossed $3,000 or something, the cost of using the network is linked to that. Now there are ways to mitigate it, and the Ethereum sort of core team that works, this sort of like contributes to the blockchain, is doing a bunch of things there. But the cost is linked to the native token, right? Which means that at that point, it became unaffordable for a lot of people to transact. And even those who could afford it, it often took like 30 minutes, 1 hour for the transaction to confirm. Because again, it has to go to a certain number of nodes, it has to be processed, has to come back, and that takes time, right? And so like imagine using an app where you hit submit and then you have to wait for a few hours to know whether it worked or not, right? Like that just doesn't work anymore, right? People are used to like there's like a study where if your web page takes more than some 700 milliseconds to load, you get 70% drop off or something like that, right? So and there are literally cases where people
Correct.
had to write down the transaction reference and then go back after 2 hours and check if it's come through or not. Now this is not to dunk on Ethereum, right? Like
Nice.
this is not to make fun of them or any of that.
Yeah.
It's just that this was the first general purpose blockchain that was built, and it was built to prove that blockchains can do any of this, can do any sort of custom merging. Now what happened because of that is there's something called Ethereum scaling solutions that were born, which means these are called layer 2, layer 3, roll-ups. If you hear any of these terms, these are Ethereum scaling solutions, right? So what they try and do effectively, there's like a whole universe behind it because VCs went and funded a whole bunch of them. But in simple terms, what they try and do is they try and batch transactions and then periodically get confirmation from the Ethereum blockchain, right? So like they're like, okay, maybe a $50,000 transaction has to be instantly confirmed on the main network, but if you're making a 1 cent transaction, maybe you can do it on a secondary network, and then we'll sort of periodically, in bulk, go and get confirmations, and those networks therefore will end up being cheaper and faster, right? Now, some of the most popular such network from India by Indian founders was called Polygon. Is called Polygon. There are many other networks for Arbitrum. There's Base, which is Coinbase's blockchain. There's a whole bunch. I'm missing out on many names here, but there's this whole ecosystem that got funded in like the 2020, 2021 phase to say that, okay, Ethereum clearly is here to stay, but it's slow. And I think to some extent, the Ethereum core team also endorsed the fact that they want to see more scaling solutions, sort of come in. And so you have one class of blockchains called layer 2 blockchains that are built to scale Ethereum, right? And now there's a real question here on whether are these blockchains secure or centralized? Is there a risk? Is there the same risk that you say a bank has? Is that same risk there with a layer 2 blockchain, right? Like, do they run their own validators? What kind of guarantees do they provide? Are they actually writing back down to the Ethereum blockchain or not? There's a bunch of these questions that are there, but this ecosystem is very real. Uh, it's raised a bunch of money. There are a few sort of serious contenders, like I mentioned, that have emerged out of this. And one of the beliefs that many people in the scaling world have is that ultimately every org will want to have their own blockchain, right? Like Amazon will have its own blockchain, or Facebook will have its own blockchain, and they will use Ethereum, or they'll use some larger settlement layer for periodic confirmations. This is one view of the world. I think it's called the app chain thesis, to say that Ethereum is the global settlement layer, and everything on top of it, every application will want their own blockchain, so they can collect their own gas fees. They don't have to pay rent to some other third blockchain or some of that. This is one view of the world, right? Another view of the world, which is where Solana came out of, or Aptos came out of, was a different approach to scaling. But before I get to that, if you want to jump in with some questions, I can take those.
It's almost like I can draw a parallel with the actual financial markets also. Practically everything that you've mentioned is exactly how even traditional financial markets have evolved. The fact that when the stock markets and listing came about, people just invested money in stocks purely for speculative purposes. Then a lot of sham IPOs came, went bust. The financial markets have kind of seen these cycles time and again. And something similar has happened even on the blockchain with crypto assets. And when you mentioned that, the cost of transaction actually going up, I could think it's very similar to how banks, when they scale too big and they have too many branches, their percentage fee on processing a transaction or collecting foreign payments also keeps going up because they need to collect enough revenue to keep the entire ecosystem and their infrastructure ready and running. And then when you mentioned that there was this another layer and they started,
Batching.
batching transactions, it's almost like IMPS, NEFT, and RTGS, saying that let's batch everything in RTGS, which
Yeah.
happens, say, these many times a day, and whatever is more real time and instantaneous, let's do it in the form of an IMPS transaction, so to say. So yeah, lots of parallels, but okay, very interesting. You were
Yeah.
you were explaining
Yes.
Solana
Okay.
now.
So this was one approach to scaling, right? And the beauty of a free market is that someone can respond or refute by just building another product, right? And so the founders of Solana built sort of Solana as its own layer 1 blockchain, not on top of Ethereum, not on top of Bitcoin, third independent blockchain, to sort of solve scaling differently at the base layer itself, right? So Ethereum sort of processes transactions sequentially, right? And therefore it's limited to a certain number of transactions per second it can do, depending on the block size that it has. What sort of Solana's main innovation was that it could process transactions in parallel at the base layer itself. So the opinionated roadmap that Solana had was that instead of depending on third parties to build scaling solutions, let's just scale the base layer itself and make it as fast and cheap and performant as possible. So the meme in the Solana world now is increase bandwidth, reduce latency, which means to say that go as fast as possible, go as cheap as possible at the base layer itself, right? Now, it sort of feels like the world is moving in this direction now. But back in 2020, when Solana launched, there was a pretty fierce debate where people said that, look, the base layer has to be scarce. It has to be like oil. You need the scarcity so that it drives value in terms of the quality of transactions that can come through, and not have all these scammy, pointless tokens and that. Versus the founders of Solana were pretty clear that no, we just want to build the cheapest, fastest, most performant system, and to make it easier for people who want to build applications, right? That was the sort of genesis of like the Solana blockchain, where they said that instead of having a scaling solution, we will just make the base layer uh, just make the base layer more performant. Now, that comes with its own set of trade offs, right? For example, the hardware requirements to run a Solana validator are way more than to run an Ethereum validator, right? There was this meme that, the goal for Ethereum was that anybody with a smartphone should be able to just run a validator like an app, within the compute that you have on your smartphone. And that's how you get a billion validators and the most decentralized network. Whereas the trade-off on the Solana side was that the cost of running a validator, even outside of the stake, right? Both Ethereum and Solana require stake. We'll sort of get into stake in like a separate video, I think. But even outside of stake, the pure infrastructure cost is pretty high if you want to run if you want to run a validator on Solana. That's because of all of this stuff that I mentioned on, like, having like parallel transaction processing. The runtime environment has more demands on compute, right? But these sort of trade-offs have worked reasonably well for Solana so far to bring it to this point, where there was a time where it was called a centralized chain because the cost of running a validator was so high. They said only whales can run a validator. Or it was called the VC chain. There's a bunch of this stuff that happened because basically it's like when people are financially invested in one ecosystem versus the other, you have this ideology become a lot more vicious than it would if it was purely academic, right? Because you're defending your bags, your
Yeah.
wealth in that sense. And so, but at at the heart of it, this was the core trade-off, right? The Ethereum ecosystem said scale through layers. That is playing out in its own way. The Solana ecosystem said scale the base layer and let everybody build on top of it. That is playing out in its own way. And now there are more alternative layer ones, like Aptos or Sway are two famous ones, but more recently, Hyperliquid is another. It isn't even. I don't even know if I should call it a blockchain. It's more of an exchange that just took the trade-offs one more level further, and it said that we just want to build the best exchange for people who want to trade, right? And they made their own bunch of trade-offs around performance versus ideology there. But this is how we branched into sort of the Solana Aptos world.
Okay. Would you say it's fair to think of it in a way that any validator is almost like you require the kind of capital or the processing capabilities to become a validator is very similar to say the capital adequacy norms that the RBI or regulators like the SEBI impose on anyone who wants to set up like a mutual fund or an AIF or get a banking license, where they would say you need to have at least this much capital to be able to engage in this business. Do you think it's again like a parallel in some way?
That's actually interesting. I never thought of it that way, but I think you could draw that parallel with a few distinctions. So the first one I would say is that yes, you do in proof of stake networks. Okay, in proof of stake networks. So we mentioned proof of work when we spoke of Bitcoin. In case of Ethereum is now a proof of stake network. Solana was always a proof of stake network. In those cases, to be able to validate transactions and participate in the network, you need to put up a certain amount of stake. Stake is basically, like you said, capital denominated in the native token of the network. In the case of Ethereum, that is done so that if you try to cheat the network, you can slash your stake, right? So you pay a penalty of that stake. If you're found cheating the
So
net,
it's
yes,
skin in the game.
exactly, you should have skin
Yeah.
in the game. So yeah, you could think of it as capital. You could basically think of it as system enforced capital requirements, so that you can quality control for the validators, and you don't get cheated or spammed out, right? Like, how do you trust an independent
Yeah.
node?
You don't get
Yes, so
bad
that
actors. You get people who are
exactly, it
well
becomes
intentioned.
expensive to get bad actors. In fact, a recent like network update on on like the Solana network is called stake weighted quality of service, which is to say that the more stake you have, the more of a role you have to participate in the network in terms of producing new blocks and validating transactions. What that does is it incentivizes anybody with a revenue generating business on Solana to also run a validator then, so that they can improve the quality of their product itself, and they're not potentially at the mercy of a competitor or an adversary who may choose to block them. Right? So there's a lot of this dynamic as well, where what if someone buys up all the stake or can corner all the stake, and can they take over the network? It's like a whole economics problem in that sense. And I say it's about designing incentives to sort of get the outcome.
Okay. Okay. So very interesting. Now can you just educate me a little on, imagine all the players that you know of in the traditional financial system, you know? So there are banks, there are stock exchanges, there are depository participants. And what are the parallels in the crypto or the blockchain network, so that it's easier for people tomorrow to relate and say, okay, this party in crypto or blockchain plays the role of this party that I understand in traditional finance.
To your question of how the blockchain world or this world maps to like the traditional finance system, I think a good way to think about blockchains like Solana, Ethereum, Base is that they provide the settlement layer and the execution layer for a lot of these transactions, right? So you could think of it as DTCC or Euroclear, which does sort of security settlement, or Fedwire chips in the US that does payment settlement. They're basically it is your custodian, it is your settlement layer, and it is your execution environment. So it sort of bundles a lot of functions into one, right? On top of that, it is also the custodian of the assets that you issue in a way. So, for example, let's say you're a company that is issuing stock through the stock exchange, right? It is you as the company can decide typically if you want to issue more stock or less stock, if you want to dilute, if you want to split, if you want to do any of this. It's largely at your discretion, right? And of course, like the securities regulator has to approve it, and then it goes on to the exchange. What happens in the case of a blockchain is that when you mint your token, let's assume in this case a token is like a stock. Not every token is a security, but if you think of a token as a security in this case, anybody who reads your token program will know if you have the right to split it or distribute it or mint more, what the total supply is. Some of these characteristics are built in right there.
Oh, so it's almost like a charter document of a company where you can read, is transferability allowed? Will there be issue bonus shares in the future? Can you trade it? How freely can you trade it? And things like that, dividend and what.
Yeah, so it is the custodian, it is the layer on which your transactions happen, it is the layer on which your settlements happen, but it's also the enforcer of rules around the token, right?
Hmm.
Now, what that results in is interest, and obviously it's a lot more nascent compared to how the kind of safeguards you'd have with regard to a company and equity, and it'll sort of get there over time. But one simple example is that if you are, let's say, an anonymous founder on the internet who is issuing a token and telling people that please buy my token, I will use this to build a product, right? One of the things that people do is they burn or they give up on the edit authority of that token, right? Which means that they can sort of publicly show in the smart contract that they can no longer make any edits to the supply or the emission schedule or any of the other intrinsic characteristics of the token, right? And that is one way people signal confidence, to say that, look, I have given up on the ability to edit the supply, versus If you don't do that, you could tomorrow choose to issue another billion tokens and keep them for yourself and crash the price and take the liquidity out, right? So in terms of comparisons, the base layer does a multitude of functions, from custody, from settlement, from issuance, from transfers. All of these are done on the base layer. Now, what happens is that people can build applications to simplify any of these functions. So I'll give you examples from the Solana world because I'm most familiar with that. But what is a meme coin launchpad, right? People must have heard of Pump Fun or any of these meme coin launchpads. It's basically taking the token issuance function and building a product or a UI and an app around it, right? And these apps have then, like Pump Fun has made, I think, $900 million in raise and $600 million in revenue from the fees that they charge for simplifying that, right? And so all of the core functions are issued on the underlying blockchain. The applications on top just choose which function they want to build on top of and make it easier for consumers to do it. So the same way that you can interact with ChatGPT through an API, or you can interact with ChatGPT through a UI, right? And most people find it easier to do it through an interface. The same way, any of these core functions, you can build an interface on top of it, and then you can charge a fee. But the distinction is that no matter which launchpad the token is launched from, the underlying token is still on the network, which means that it is still, subject to the same rules of the network. Anybody else can choose to make it tradable or listed. You can't say that because it's launched on my launchpad, it will only trade on my launchpad, or I will not let you list it. I will charge you a listing fee. You can't do any of that stuff, which is where the distinction sort of comes in. If you take, for example, payments as an example, right? Payments is a great example of a function that's built on top of blockchains. Yeah, people may have heard of the Stablecoin Act that recently passed, and stablecoins. We've done a few episodes on stablecoins as well with Cast and some of these folks. Um, Effectively, a stablecoin is like any other token issued on the underlying blockchain, right? There's not much technical difference between a meme coin and a stablecoin, except for the fact that the issuer of the stablecoin makes certain guarantees that the stablecoin is always redeemable one for one against an underlying currency and things like that. So you're using the base layer to do the token issuance, for people to custody the token, for people to transfer the token, but you're building an app on top of it. You're building APIs. So Circle is a company that does stablecoin issuance. They have APIs that you can use to interact with USDC, which is their main token that they issue, right? That's largely a good way to sort of think about the stack.
No, it is. It's almost like I'm seeing that a lot of the intermediaries are kind of getting bundled together. And also, when I say there's a lot of bundling of entities, it's almost like the central bank, which is the issuer of the currency, then your SEBI, your exchange, your bank, literally each blockchain or crypto network is trying to solve all those layers and then more evolve as more use cases arise. And then people are like, okay, for some other use case or in some other market, this one solves the need of a particular kind of customer better than the other, and then people are building applications on top of it. It's almost like an ATM, and someone liking the interface of a particular bank's net banking a lot better than another bank. So you would gradually have people building loyalties towards their specific use case. Someone would want to list on a BSE or an NSE. Doesn't mean that one is better than the other. It purely depends on one is older, one is newer, one has more transactions, the other is lower transactions, but it's all kind of coming together in a regulatory framework. And what you're saying is this regulatory framework is also self-imposed as the market evolves. The code being written on the framework is in a way regulation. Now it will come to a point where certain governments will say we see the most amount of trust in this particular crypto because it's most secure for a retail investor. Or it may so happen that the government may decide to come up and replicate one such model for its entire nation. Do you think that will solve a problem, or that means we're kind of back to square one in some way?
One of the things we've seen is that while it's valuable to build a custom application, because the application can focus on that particular use case. It can tailor its UI. It can really go deep on solving one problem. There are benefits to aggregating liquidity at the base layer, right? And so when you sort of
Absolutely.
speak about picking and choosing, it's more like there's also, so the thing is, a lot of market direction gets defined by what gets funded, right? And because Ethereum as a layer one blockchain had a very high market cap, a lot of blockchains started getting funded. That era is now over. You can't raise, like a $20 million seed round to build the next XYZ blockchain. It's much harder to do. I'm not saying that there will be no more blockchains. There will be. It's just the bar is higher now. There were people who were trying to build purpose-built blockchains. So there was someone who said, I'm building a blockchain for real-world assets. There's someone who said, I'm building a blockchain for insert use case, right? Whichever use case you thought you could sell at that point, you said, this is what I'm building it for. And these may be well-meaning people, because, when you look at the crypto industry from the outside and you see like fart coin and to the moon and come rocket and all of this, you're like, this can't be a serious industry, right? Like, I don't want to go do business here, obviously. But effectively what ends up happening is that liquidity aggregates, right? And what we're seeing is that if you're the base layer where like where anything and everything can happen, you get the best and the worst of both worlds. So on like Solana today, I can only speak for that because I sort of know the most about that. You have meme coins being launched, which are purely speculative. In People can speculate as they please to, but you also have money market funds getting tokenized. You also have public equities getting issued. You also have stable coins being issued. The reason for that is there's no fundamental distinction between the market infrastructure for token issuance to for token transfers for price discovery between a meme coin and whatever your high priest asset is, right? It's the same infrastructure. It's the same program that does the issuance. It's the same program that does the swap. It's the same program that finds the price, right? And so there's liquidity at the base layer is aggregating in that extent. But of course, there are, let's say, KYC implications. So somebody who is issuing tokenized US equities will work with the SEC and say that, okay, what are the compliance guardrails that you need, and I'll make sure that we abide by those when we issue it. So we'll make the token non-transferable outside of the US, let's say, right? Like only US citizens can hold it, non-US citizens. You can do some of these things. And in the US at least, it seems clear that my guess is that I don't think they're going to try and build their own blockchain uh, at all. In fact, there are 3 bills that are being passed in the US right now. There was the Genius Act, which is a stablecoin bill. There is another act called the Clarity Act, which is a Market Structures Act. And then there's a third act called the Anti-CBDC Act, right? The Anti-CBDC Act literally means that the US Congress is barring the US Fed from issuing a CBDC until approved by the Congress. So they're literally passing legislation to slow down any kind of government-created blockchain in the favor of free enterprise, right? Largely, at
Also,
least.
it's almost like can't we won't get any more Trump coins, or it's going to be more difficult to get more Trump coins out.
No, the thing is, the like Trump coin was a meme coin, right? So whoever is launching that can launch it as a meme coin, but you won't get a nationally issued version of the dollar, right? And of course, okay, again, they have their own private interest to do that because they want more buyers for US treasuries outside. As of now, like Tether is the 4th largest buyer of US treasuries in the last year, and overall the 18th largest holder of US treasuries, right? Which is like a stablecoin issuing company. If you had to rank them with countries, I saw a stat which said they would be number 18 on the list of people who hold. So for the US, they have their own incentive to do it. They're not doing it out of the love of like spreading decentralization, which is also fine. Like these things play out through market forces. But to like aggregate everything and answer your question, I would say that the most interesting place to look at for anybody who wants to get involved in a non-spec, in a pure in like outside of trading and investing, right? Because like I don't think either of us are very interested or are even qualified to give advice on that. Maybe you're qualified, but we're not here to give advice on that. Right? For anybody interested to get involved with the products being built, with the more, or like just generally the more interesting things, they are happening on general purpose smart contract blockchains. It could be Solana, it could be Base, it could be Polygon, it could be Arbitrum, could be any of these. where applications can be built. Now, each one of them takes an opinionated bet, right? Like Solana says, everything at the base layer, fast and cheap, aggregate everything. EVM says, scale it up. Every app will have its chain. We'll scale and use Ethereum. You can pick and choose whatever ecosystem you think you sort of want to focus on. But this is where majority of the products are getting built. Right? This is where you could go and join a company. This is where you could start a company. This is broadly the space in which you can do any of this.
Wow. Yeah. I realize there's still so much to cover and it'll take multiple episodes, but it's great because it's almost like we're recording all these conversations where you're educating me on these topics, and hopefully I will be able to go back and revise a lot of these subjects, and a lot more people can use this as a way to jump onto learning more about blockchain. So thank you, Aditya. Thank you for really doing this with me today.
Awesome. This is great.